Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Investing in growth stocks usually captures the headlines and gets people talking. While investing in equity income strategies may not be as sexy, it plays a very important role in investment portfolios. I mean, who doesn't enjoy collecting a check periodically, and who isn't or who doesn't have a dream of sitting on the beach enjoying a cocktail while knowing you are collecting income from your investments? Well, I have on the perfect guest to talk more about income investing and different strategies. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome Lance McGray. Lance is the managing director and head of ETF product at Advisors Asset Management. Lance, thank you so much for coming on the show. It's an honor to have you on. I'm really excited about this conversation as I know it's going to be a great one. Now, can you please tell us a little bit more about yourself in Advisors Asset Management?
Yeah, absolutely, Ryan, and certainly a pleasure to join you on this call today. Certainly appreciate it. So thank you very much. Yeah, so a little bit about myself. I'll spare the long out of grad school to sort of join on with a $3 billion hedge fund in Greenwich, Connecticut as an analyst. Unfortunately, a few years later, as many hedge funds did in the great financial crisis, we liquidated all our funds. And had the great opportunity. I actually had another hedge fund coming out of the existing fund that we liquidated. A really tough decision, but I took a leap of faith into this little thing called an ETF, and a major advocate of ETFs ever since for almost 20 years now. For the last 20 years, I have been at ETF issuers launching ETF products, and here I am at AAM. Been around since 1979 for products, everything from alts to SMAs, mutual funds, ETFs. We actually even have a bond broker dealer, which services a lot of IBDs on the bond front. So activity and a firm, quite honestly, that many folks aren't aware of.
Yeah, you guys are doing fantastic stuff. I've had Cliff, your CIO, on numerous times. Love talking. The research you're doing, the products, the strategies have been great. So I love it, and hopefully more people learn about AAM to see all that interesting stuff that you guys are doing. Growth strategies, I guess, they've been the darling of markets recently, in large part due to the strong performance of mega tech and AI related stocks. Why should investors continue to invest in equity income strategies when maybe you can get more returns, more alpha, potentially in growth names? And what makes a strategy still attractive?
Yeah, I think this is a conversation that we have at AAM pretty much on a daily basis. And I will say the majority of AAM products, and we certainly do offer growth strategies and exposure to the Mag 7 and what have you. But really, AAM for 40 years we've been built on income, right? Income, as you mentioned, who doesn't want to be sipping a pina colada on the beach, collecting a coupon or getting a dividend and not having to work about it. But it's in this environment, right? We look at the last 4, 5, 6 years, right? Outside of a year here or there, the major broad-based indices are up 20, 30%, on back-to-back years. It's hard to, a lot of folks will say, if it's not broken, why fix it? And the point is, finding alpha in this environment is extremely challenging when you're going up against the S&P 500, which, we would say is pretty much a growth fund, right? The Mag 7 is 30% of the index. So in order to really create alpha, right, you need to create active share. And in order to create active share, you need to move away from these broad-based indices. And it's awfully hard to step aside from the Mag 7 because really that's what's driving the market forward. So, in terms of why income, right, it comes down to a few things, right? If interest rates continue to fall down, people are going to be looking for income, right? Equity income is always something that's very valuable to folks. But also we think, there's an opportunity that, the generation of alpha or total return is going to be driven by dividends, right? And, it's been an interesting environment over the last decade or so in that everything's been growth, 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 growth. But for the listeners and many folks out there, they don't realize the importance of dividends and the compounding of those dividends over time and what that means for future returns. We think number one, it provides income, but number two, most importantly, it provides the diversification, future expected returns after 25+% annual returns might not be in the picture. So if it's not, how can we de-risk the portfolio? How can we create additional diversification? And in the meantime, how can we generate yield and income?
Fantastic, Lance. You brought up a couple very good points. Number one is that compounding interest, right? Einstein's eighth wonder of the world, compounding interest, and time is, hopefully for a lot of us is on our side there. And then income and diversification. Yeah, I do believe moving forward that diversification asset allocation is going to become much more important, and income strategies helps diversify and you know provides that income, like you said, pina coladas on the beach while you're collecting that dividend. What's not to love there? Um, and
Absolutely.
we talk about dividends and yield, and when we consider and start talking about equity income strategies, I think our first thought goes to dividend paying stocks. The those GEs of the world, utilities, and so on. But there's other equity income strategies. What are some other underutilized income strategies that maybe investors or financial advisors should consider?
Yeah, I think if we want to stay on the theme of dividends for the time being, right, I think it really comes down to, two major types of way to invest in dividends, right? And I think the longest standing way to invest in dividends is really to identify those companies, those stocks that are generating high levels of income, right? The high dividend payers, right? And over the last 10 to 15 years, those stocks have actually very much underperformed the market, right? In an interest rate environment that's pegged essentially at zero, growth is, as we mentioned, through the roof. Those high yielding equities have pretty much, well underperformed the market. So that's one way to tap dividends, right? And, historically that's done very well, but over the last decade that has not. Another way to tap dividends or the benefits of dividends when it comes to equities is really not necessarily looking at the stocks that are paying the highest level of dividends, but to your point around compounding of income is looking for those stocks, those high quality names that may not be generating the 4, 5, 6, 7% that people are looking for, but those that are generating, dividend yields in line with the S&P 500, but have the ability to grow those dividends over time and compound those dividends over time. So those are more the dividend growers, right? And I think those are two of the big areas that, dividend investors look to. And often those are kind of held in different silos, but we here at AAM think there's an opportunity here to identify those high levels of dividend payers, but also those companies that can support that with high free cash flow and the ability to maintain and grow those dividends. So a lot of options out there in the dividend space if you're looking for income and potentially capital appreciation as well. But to your point about other areas of income, one of the more underutilized area of the market that we think is very attractive for investors right now is the preferred stock space. And I think that's an area that if investors are looking for diversification, if they're looking for high levels of income, and also on top of that, very tax efficient income, the preferred space is very attractive right now.
Interesting. So let's talk a little bit more about preferreds. I think, investors, financial advisors may understand them, may not, might be a little gray area there. Why preferreds, and what benefits do they bring to an investment portfolio?
Yeah, the users of preferred stocks, some investors really like them because of the elevated levels of income. Again, these are hybrid securities. So these are securities that don't necessarily fall in the bucket of, say, equity or fixed income, right? They have characteristics of both stocks and bonds. And for that reason, many investors kind of either stay clear of them or don't fully understand the risks and the benefits of them. But it really comes down to many folks invest in preferred stocks because, yes, they generate a tremendous amount of income, right? And that income is really derived because of where these securities fall in the capital stack of a corporation, right? So they're below the senior debt and above equities, and for that additional risk, you get elevated levels of income. Now, I will say, right, this is I think about a $2 trillion market. Many of these preferreds are investment grade securities, right? So you're getting a elevated level, a pickup in income level, but in some instances, these are still investment grade securities. So it's very attractive. And then finally, I mentioned the high levels of income, but the tax benefits, right? For those tax conscious investors, the majority of the income that's generated by preferreds is QDI, or qualified dividend income. And that's really, really important for those that are worried about tax bills because unlike ordinary income, right, as a bond, QDI is taxed at long-term cap gains rate instead of ordinary income. So very attractive. You take an asset class that's generating a high level of income, and then you essentially provide QDI, roughly could be up to 75% QDI on that income level. So you're looking at income levels, well above that of possibly at a high yield market, investing in 50% investment grade securities. And like high yield, unlike high yield, you're not dabbling in sort of, the quasi junk bonds, if you will. So very attractive marketplace right now. And lastly, I would say right now they're trading at a discount. Believe it or not, coming out of the regional banking crisis, preferred stocks are still trading at a slight discount to where they have historically. So you kind of have a built-in cushion, if you will, right, in terms of future potential capital appreciation if you're looking to enter into preferreds right now.
I love that you brought up the taxes, the tax benefits. I think we should always be considering talking about taxes, especially when you're looking at financial planning. But I don't know if it's talked enough about, and the tax plan is getting to be more and more important. And so I love that you brought that up. Thank you, Lance. So you also earlier talked about interest rates falling, which likely makes value or income investing more attractive to the higher yields. So let's talk about that macro environment. We're amid a Fed rate cutting cycle. Who knows how many more cuts are in this cycle until we reach neutral. But is there a macro or an investment backdrop that preferred stocks tend to perform better during?
Yeah, I think there's a few things, and maybe it makes sense to sort of walk this back a little bit and sort of talk about some of the risks of preferred stocks, right? Because I think we need to understand, just like any investment, right? They come with risks, and it's very important that investors understands the risks of any asset class or any investment that they get into. And as you can imagine, with preferreds, right, most investors, if I was to take a poll of, what risks lie with preferred stocks, many would say, credit risk,
Yeah.
right? And I think that's fair, but there are a lot of risks associated with preferred stocks that many investors aren't aware of. I think that's a byproduct of maybe, not being educated about the asset class, but it's also a byproduct of being in a market that has had essentially very low interest rates for a very long time. And you're just like, why are you talking about interest rates? Because I'm talking about duration risk, and specifically duration risk with preferred stocks. And for those that know preferreds, these are, in some instances, perpetual securities. There's no maturity. So from that standpoint, this asset class, these securities carry substantial duration risk. right? And that could be very beneficial in certain market environments, and it can be harmful in certain market environments. So coming back to the current environment we are in, right? You mentioned, potential for future rate cuts, right? So in this environment, right, do we want to extend duration or minimize duration? Right? What happens if, inflation becomes sticky and all of a sudden rates are paused and all of a sudden the Fed, for some reason has to start hiking interest rates again? The point that I'm trying to make is, I don't think anybody has a crystal ball. And what we're trying to do when we invest in preferred stocks, or what we recommend to do when we invest in preferred stocks, is to remove as many of these variables as possible. And that's kind of why, at AAM, we have a solution, PFLD, that's a low duration preferred product, right? So it's a very evergreen solution. It's a product that you can invest in preferred, you can get the benefits, you get the diversification. But if interest rates start swinging, if interest rates go down, if interest rates go up, right, you mitigate your risk to that essentially interest rate move, or the duration risk, if you will. That's really can be very impactful for preferred stock. So I think duration risk is one thing that you need to keep an eye on. The other is call risk, right? We know with preferred stocks, there's a lot of call provisions, right? There's optionality, embedded options in these securities. And if you can monitor and manage your call risk, you have the potential to outperform in the long run. So again, a lot of risk when it comes to preferreds: credit risk, duration risk, call risk, reinvestment risk. And it's really important to understand, how these risks play out in the market environment that we're in and the product that we're looking at.
I'm really glad you brought that up during this whole conversation. We talked about the benefits, and there's no free lunch, Lance. There's no free lunch in this industry, so there's always got to be risk. So it's about balancing the return versus risk, and that goes into play. What you talked about earlier is diversification within a portfolio. Well, yes, preferreds and equity income strategies help diversify. There's still some risks there. And
Absolutely.
I'm glad you brought up duration. Duration is a very common topic. And a lot of people, when they think of preferreds, you mentioned at the opening, it's, a balance between equities and fixed income. Like, preferreds have, characteristics of both. And some people may not think duration impacts it. And you talked about duration is very high in preferreds. Like, how is it compared to other high duration
Yeah.
securities, like longer term bonds that have higher duration? Is it a higher duration than those, or?
Yeah, so when we talk about duration of preferreds, right, if you think about the broad-based preferred index, the duration of that will generally be, even though these are perpetual securities, you can say, whoa, they probably resemble more of a long-term bond, right? 20 plus years. And in reality, that's not the case, because despite these products, these securities being perpetual in nature, they have these embedded options, right? They have call features. So the issuer can call back the preferred at par at a specific time or a specific price. But there's also something that I think is really important to talk about that impacts sort of the duration, and that's the coupon structure of preferreds, right? Some are fixed, some are variable, some are floating. And all this does is essentially, it adjusts the future cash flows of these securities based off of interest rates, and therefore you could essentially calculate your duration. So it's really, really important when you're looking at sort of the interest rate sensitivity of preferred stock. Look at what is called option duration, option adjusted duration. And what that does is it essentially takes in all the call features of the security and essentially puts it into one and prices that as in terms of the effective duration. So an option adjusted duration. So to sort of come back to your original question, think about the ag, right? The ag is probably going to be in that 7 to 8 year duration. Broad-based preferreds right now are pretty much similar, slightly less than that. So if there's a move, 1% move in interest rates, it can be very harmful for the impact in terms of the price of preferreds. But getting back to my comment around low duration preferreds, this is really interesting because you can take an asset class that has an option adjusted duration of, say, roughly 6.5 to 7 years right now. You can focus on the low duration preferreds and essentially have a pool of 200 or so preferred stocks that are about 40 to 45% investment grade, and bring down your duration or interest rate exposure down to about 1.5 years. So you're getting the same benefits of the preferred stock asset class. You're getting the diversification. You're getting the low correlation to stocks and bonds. You're getting the high QDI levels, right? PFLD has a QDI of 75% right now. So by removing some of the risks associated with interest rates and duration, you're actually able to capture a lot of the benefits of this asset class and do it by reducing your duration, by 50% or more, which I think in this type of environment where, there's so much uncertainty around interest rates, if you can remove that uncertainty and still get very high levels of income, tax efficient income, it certainly, in our opinion, it makes a lot of sense for many investors.
Yeah, that's a great point, because I feel over the past couple of years, interest rates and whether we put too much into what the Fed does and Fed speak, um, it's driving markets, and it's just not fixed income. It's also equities. So to
Mhm.
be able to kind of hedge that and reduce your duration just is another benefit to adding it to investment portfolio when
Yeah, and
so
I
many.
would say to that point, I would say, it's, when we ask investors or potential investors why you invest in preferreds, and the first thing is going to be tax efficient income, right? If you invest in low duration preferreds, may you be giving up a little bit, if interest rates continue to come down on the capital appreciation front, absolutely. But I think the majority of investors that invest in preferreds are doing it for the elevated levels of income. So if you can take off 60 to 70, potentially even 80% of your duration risk off the table, right? We're not saying you don't want to extend duration in this type of environment, but the point that we try to make is there's other areas of the portfolio that you can utilize to extend your duration. You're not getting compensated for it necessarily on the income front with preferreds. So take that duration, take that risk off the table, and extend the duration somewhere else if you're looking to sort of get into that intermediate, area of the bond market or the yield curve to sort of extend your duration.
Yeah, fantastic. And I'm assuming, when you get into preferreds, it's, should be like fixed income, a long-term investment, right? You're not, short, obviously not trying to time the market and trade it off. And you should think of it long-term.
Absolutely. These are, in terms of asset allocation, right? I mean, if there's anything I learned over my last 20 years, and you hear it all the time, do not try to time the market. It is a losing proposition. So it's all about asset allocation, to minimizing your risks and creating that portfolio that you can sleep with at night, right? At the end of the day, that's super important.
Yep. And collecting those checks while you're sipping on pina coladas on the beach. You know, you did such a great job at talking about like all the different things you need to consider when talking about investing in preferreds, and the different, calculating duration, and you have to factor in the call and call provisions. That while you're talking about that to me, it was like, I better let professionals manage their preferreds and me trying to search through different preferreds and trying to build a portfolio of individual preferreds. Should investors take an active approach to investing in preferreds, such as a managed product, whether it's a separately managed account, an ETF, mutual fund? I'm assuming that's the best way of gaining exposure.
Yeah, and I will say this uh, as a member of the AAM team, right? We offer solutions of active strategies, passive strategies, rules-based strategies, not so many beta solutions, but I think there's kind of a misnomer when it comes to, active versus passive. And I want to come back to the ticker that I mentioned earlier, and that's PFLD, right? This is the AAM Low Duration Preferred and Income Securities ETF. It's the only low duration preferred ETF out there. And this is a rules-based product, right? So there is an underlying index that essentially at the end of every month removes securities that have an effective duration of greater than 5 years And then also to minimize your call risk, remove securities that are trading north of 105% of face value, right? So you're essentially every single month, you're getting a low duration portfolio of securities that are not trading, that are very attractively valued, right? And that in essence is really an active strategy, even though it has an underlying index. It's rebalanced every single month. It has a relatively high active share. It has high turnover, which in the world of ETFs, quite honestly, is not a deterrent, but it's actually, in my view, it's a benefit because of the ETF wrapper. So I think it really comes down to understanding what you're getting into, right? When we talk about active managers, in many instances, what do the active managers talk about? What makes them so special? It's their process, right? It's their process. It's they have an idea, they stick with their process through and through, and that's what makes them successful. In the instance of PFLD, it can't get more process driven than an underlying rules methodology that you can look at and say, this, I know what I'm getting. So again, it comes down to what you're looking for. Is it a beta solution where, you're just bundling, all 500 issues, exchange listed preferred issues into a portfolio and just letting it run? No, right? In this environment, we don't think that's the best way to go. But whether you're looking at a rules-based strategy that essentially replicates an active manager, or you're looking for an active manager that has real, expertise in a certain strategy or asset class. The one caveat I will say is when it comes to management, active versus passive or rules-based preferreds, one thing to keep in mind is always the expense ratio, right? I mentioned PFLD. It's a rules-based strategy, but it is very much active in nature. The average rules-based preferred ETF expense ratio is 43 basis points. On the flip side, if you look at the average expense ratio of all active preferred strategies, it's up around 84 or 85 basis points. So the point I'm trying to make is an active strategy is very much worth it if you find a great active manager and they're providing what you want them to provide you. But there are passive strategies out there like PFLD that can accomplish something very similar for those that are open to rules-based strategies.
And like you said, you got to know what you're getting and what you're investing in, right? Really do your due diligence on the manager to make sure your client's
Absolutely.
objectives align with theirs. You mentioned when you were talking about PFLD, you're filtering for prefers that have a duration under 5%. That's got to be difficult. There can't be probably too many out there, are there?
Yeah, right now, in terms of PFLD, there's about 200 issues in PFLD. So you're getting the diversification. As I mentioned, you're sort of, one of the other objection we get with preferreds is like, I don't have the time to research individual preferreds, right? And so a product like PFLD allows that investor, that financial advisor, the ability to say, you know what? I really like the exposure given through low duration preferreds, but I don't have the research team or I don't have the time to do this. So let me understand PFLD's underlying index methodology. And if it's something that I can get behind and I can see the benefit of, getting that 6.5% yield, 75% QDI, minimizing your duration risk and using that risk elsewhere in the portfolio, it makes a whole lot of sense in our opinion. So yeah, so there's about 200 individual exchange listed preferreds in PFLD. And the last thing I'll mention is you take an asset class, elevated levels of income, high tax efficiency, and then you pair it with a tax efficient ETF wrapper. And it's a very easy way to access preferreds, specifically low duration preferreds, and use as a building block within your portfolio.
Yeah, great stuff. And you talk about just preferreds, and it gave me, and after talking to you, it is definitely one of those asset classes. And you mentioned earlier, it's easy to go pick out one of the magnificent seven, go invest in all seven of them individually, and you don't have that
Exactly.
expense ratio. Here it's an asset class. We talked about the benefits, but it's something, let AAM handle the management of it, because it saves yourself a lot of time. This is a space where it's worth it. So
Absolutely.
Where can our listeners go to gain exposure to preferred? You talked about PFLD, where they can learn more about that strategy.
Yeah, we can learn more on the AAM website. So that's going to be www.aamlive.com and then /ETF. You're going to see our whole suite of ETFs there. A lot of dividend income solutions, both rules-based and active. You'll see our first fixed income solution that just launched last month, actually a few weeks ago. And obviously, that's where you'll get a lot of content, presentations, fact sheets, information, white papers on PFLD and the rest of the AAM ETF lineup.
Fantastic. I like that we got a few minutes left here, Lance, and I always like that if we have time, finish with a fun story. Any fun, interesting stories you've experienced recently? Maybe the ETF space is just fascinating to me right now with all the different issuances and new ETFs. And it's just a crazy, all the different strategies out there. It doesn't have to be market related. It could be
Yeah, I
something
think
with the holidays.
I think the one thing, you're putting me on the spot here, but I think the one thing we were just at our national sales meeting last week in Houston, Texas, and as somebody that sort of spearheads ETF product at AAM, right? So I'm in charge of what our product pipeline looks like and things of that nature. And we're relatively new to the ETF game, right? AAM, we've only had a few ETFs out there for a number of years, and despite bringing great products to market and low expense ratios and fee waivers and all this stuff and content and collateral. At the end of the day, it's still about awareness and raising awareness and getting track record, right? A lot of investors need a 3-year track record, 4-year track record. And I was like, I apologize. I can do all these things, but I don't have a magic ball. I can't speed up the calendar and get us to that 3-year track record, right? And it's like, those are, in the seat of an ETF product person, like those are the things that just, make it so funny. It's like, yeah, I wish I could speed up. I wish I could raise awareness, but unfortunately, we're going to have to wait 3 years to get to our 3-year track record, and then we'll go from there. But, I found that comical. That's, I guess that explains to you where I am in terms of my desire and where ETF product development lies in my career and my life. But I thought that was funny.
Well, and you also bring up a good point, like all these new, whether it's ETF or just that product in the investment management space that it's created in the past really 3 to 4 years. It's been a very interesting 3 to 4 years, right? The markets over the past 2 years have had a fantastic rally. We're close to 60%. So it's an interesting time to start. Right?
I think to that point, though, I fully understand that, investors need to make sure that the strategy is working, the piping is in place, the issuer is under control, they can manage the strategies, right? And I think, we've seen a major pickup in option strategies and derivative strategies, and rightfully so, right? You need a track record. You need to show that you can carry out the strategies before you can invest in them. But yeah, unfortunately, I can't speed up time. And, that 3-year track record will come in 3 years, and that's about it.
Yeah, well, I'm glad you can't speed up time, Lance. So, thank you so much for coming on the show, Lance. It's been such an honor and privilege to have you on. You brought such great insight about a topic that people know about, but I don't think really understand it. So, thank you so much. It was a really fun conversation. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Lastly, please follow us on the Zephyr LinkedIn page to learn more about Zephyr, and like and subscribe to the Zephyr YouTube channel. Thank you very much and have a great rest of your week.